Hello everyone. In the previous video, we started with the topic monetary policy and various quantitative instruments of the Reserve Bank of India or the central bank, which are used by it to control the money supply in a particular economy. In the previous video, we studied about the three quantitative instruments that were bank rate, repo rate and reverse repo rate. So today we are going to start with the fourth quantitative instrument, that is CRR, also known as cash reserve ratio. About this ratio we have studied about in the credit creation process also, which refers to the minimum percentage of bank's total deposits required to be kept with the central bank. That is, it refers to the minimum percentage of the bank's total deposits which are required to be kept with the central bank by the commercial banks. So let's say, and the CRR is also set by the central bank. So let's say the RBI has set the CRR as 5%. Now if the 5% is set as the CRR, what is the minimum requirement now? Suppose the deposits with the commercial banks are of rupees 1 lakh. Now commercial banks have to keep 5% of this 1 lakh, that will be equal to 5,000 rupees. Now these 5,000 rupees are to be kept as cash reserves with the central bank of a particular country, and in case of India with the Reserve Bank of India, the commercial banks need to keep rupees 5,000 as the cash reserves. Might it be the private bank or the public bank, they have to keep this cash reserve with the central bank according to the minimum percentage set by them. Now what happens in case of inflation or deflation? How the CRR is used to correct such kind of situations? Now as we know, in case of inflation, we have to decrease the money supply. So what the Reserve Bank will do? They will increase the CRR, that is, if earlier it was 5%, maybe they may increase it to 6%. So what will happen then? It will lead to increase in the cash reserves. That is, now the commercial banks have to keep 6,000 rupees as the cash reserves instead of 5,000 rupees, because of which they will be only left with 94,000 rupees for lending the loans, and earlier they were left with the 95,000 rupees by deducting 5,000 as the reserves. अब जो इनके पास 94,000 rupees बचे हैं, that had decreased with the increase in the CRR, and after that there will be decrease in the money flow in economy, and which will lead to the control of inflation, or the inflation will be combated with the increase in CRR, because commercial banks have to maintain more cash reserves with the central bank. And in case of deflation, the opposite will happen. What will happen is the CRR will be reduced by the central bank. That is, if it was 5%, maybe it becomes 4%. Now in this case, the reserves are to be maintained of only rupees 4,000, and rest 96,000 rupees can be used for lending the loans. Therefore, in case of deflation, when CRR is reduced, it further leads to the decrease in the cash reserves, and further the lending power of the commercial banks will increase, and that will further lead to increase in money flow in economy, and the condition or the situation of deflation will be controlled. So this is how CRR works in a particular economy. Now next ratio comes is the statutory liquidity ratio, also called SLR. About this ratio also we have studied, which is also one of the components of the legal reserve ratio. Basically these two ratios are the ratios which are to be legally kept or legally required to be kept by the commercial banks. Now statutory liquidity ratio, it is the fixed percentage of assets, of liquid assets basically, which a commercial bank is required to maintain in the form of cash, gold and marketable securities with themselves. Now in CRR, the commercial banks have to keep the cash reserves with the central bank, and they need to maintain a fixed percentage of the liquid assets with themselves, which may include in the form of cash, gold and marketable securities. Now let's take an example of this. Now suppose the central bank has set the statutory liquidity ratio as 20% of their total deposits. That is, commercial banks need to keep 20% of their total deposits in the form of cash, gold and marketable securities with themselves. Now let's take the same example, that is the commercial banks are having with the deposits of 1 lakh. Now 20% of this 1 lakh equals to 20,000. Now what the commercial banks need to do is, अब ये जो 20,000 की अमाउंट है, इस अमाउंट का उनके पास या तो कैश होना चाहिए, गोल्ड एज वेल एज द मार्केटेबल सिक्योरिटीज मस्ट बी केप्ट विद देमसेल्व्स ऑफ द टोटल अमाउंट ऑफ 20,000 rupees, and the rest 80,000 rupees can be used by them for lending the loans. So here also it works like CRR only, that is, in case of inflation, SLR will be SLR will be increased in this case. That is, in case it was 20% earlier, it may be increased to 21%. So what will happen? There will be increase in the reserves, or you can say increase in the liquid assets. That will lead to decrease in the lending power. Further, the money flow in the economy will decrease and inflation will be controlled. Similarly, in case of deflation, the SLR will be reduced. Maybe it may be reduced from 20% to 18%. So in that case, there will be decrease in the cash reserves and the lending power of the commercial banks will increase. Further, there will be increase in the money flow in economy and the deflation will be controlled. So this is how the SLR also works in case of inflation and deflation. Now comes the last quantitative instrument, which is called OMO, or open market operations. It is normally defined as the sale and purchase of government securities in open market. Now what that means? Now what RBI will do? RBI will either sell or purchase the government securities in the open market. And open market may include the general public also, as well as the banks also. So जो सेंट्रल बैंक के पास गवर्नमेंट सिक्योरिटीज़ होंगी, वो क्या करेंगे? टू कंट्रोल द सिचुएशन ऑफ इन्फ्लेशन और डिफ्लेशन, दे मे इधर सेल द सिक्योरिटीज़ टू द पब्लिक और बैंक्स, और मे इधर परचेज द सिक्योरिटीज़ from the banks or the public. And this open market operation is done with the help of either in outright open market operations, or another one is repo open market operations. Now what is the difference between the two? In case of outright open market operations, these are permanent in nature and the sale and purchase of the securities is done without any promise to buy and sell them later. For example, the Reserve Bank of India has sold the securities to the commercial bank. In case of outright, there is no promise given, or the buying and selling of the securities is without any promise to buy or sell it later on. The simple thing is that इसमें कोई भी promise नहीं करा जाता for buying or selling of the security further on the future date. But in case of repo, as the name suggests, repurchase, which we have studied in the case of repo rate also. In this case, there is a promise of repurchase or resale of securities. Basically, this selling or buying is done through an agreement with specific date and price at which it will be repurchased or resold, which means the only difference between the two is that it does not contains any kind of agreement between the buyer and the seller for further purchasing or selling on the future date. But in case of repo rate, there is an agreement or a promise involved in which the securities might be repurchased on the future date at a predetermined price. Now, how this open market operations is worked or is operated by the Reserve Bank of India to control the situation of inflation or deflation. As you can see here, in case of inflation, the central bank will sell the government securities. Obviously, if they will sell the securities, there will be absorption of liquidity or cash from the market. That is, the people will give the cash for buying the securities, and which will lead to the less money in the economy, or You can say that जब भी सेंट्रल बैंक सेल करेगी गवर्नमेंट सिक्योरिटीज़ को लेट्स से टू द कमर्शियल बैंक्स, सो उस केस में क्या होगा, जो कमर्शियल बैंक्स के कैश रिजर्व्स होंगे, और यू कैन से द मनी विद द कमर्शियल बैंक्स विल डिक्रीज और देयर विल बी एब्जॉर्प्शन ऑफ द लिक्विडिटी और कैश which will further lead to less money in the economy, or the credit creation capacity of the commercial banks will also reduce. Therefore, the money supply will reduce in an economy and the inflation will be controlled. On the other hand, in case of deflation, there will be purchase of government securities, that is, the Reserve Bank of India or a central bank will purchase the government securities, which will lead to the injection of money or increase in the liquidity or cash in an economy, which leads to more money or increase in the credit creation capacity of the commercial bank, as commercial banks will be increased with the money with themselves, and it further will lead to the control of deflation, or the deflation will be combated in this case. So what you have to keep in your mind is, in case of inflation, there will be sale of government securities, and in case of deflation there is purchase of government securities by the Reserve Bank of India. So this was all about the quantitative instruments used by the central bank of a country to control the situation of inflation or deflation, or to control the money supply in a particular economy. In the next video, we will study about the qualitative methods or qualitative instruments which are used by the Reserve Bank of India under their monetary policy to control the money supply. So this was all about our today's video. Thank you so much.